Starting a business becomes much harder when you know exactly what you want to build, but you do not have enough money to get started. In this video, we will explain how to get free money to start your business with practical step-by-step roadmap. Number 1. Start with money you may never have to repay. When most new entrepreneurs need startup capital, they immediately think about business loans, credit cards, or investors. But before taking on debt or giving away ownership, it makes sense to investigate non-repayable funding. If you qualify, this money can help cover certain startup expenses without creating another monthly payment. One place to investigate is government-supported grant opportunities. Federal, state, and local programs sometimes provide funding for businesses that meet specific goals. A program might support innovation, manufacturing, research, rural development, job creation, energy efficiency, community development, or businesses operating within a targeted geographic area. However, there is an important misconception to avoid. The federal government does not simply hand every new entrepreneur a general-purpose check to start any business they want. Many government grants are highly specific. Your business must fit the program's purpose, eligibility requirements, and permitted use of funds. That is why state and local opportunities deserve attention. State agencies, cities, counties, and local economic development organizations may operate programs designed to encourage entrepreneurship or investment in particular communities. Depending on the program, funding may support storefront improvements, expansion, workforce development, technology, equipment, or other approved business expenses. Your location can therefore change your funding opportunities dramatically. Two entrepreneurs starting similar businesses in different states or even different cities may have access to completely different programs. Search your state economic development agency, city or county business resources, and local small business development center rather than relying only on broad internet searches. Nonprofit organizations and private foundations can also provide small business funding. Some programs focus on entrepreneurship, underserved communities, neighborhood development, sustainability, technology, or particular industries. The award may be smaller than a major government program, but even a few $1,000s can make a meaningful difference when you are starting lean. Some funding programs are also designed for particular groups of entrepreneurs, including women, veterans, minority entrepreneurs, or founders in historically underserved communities. Eligibility varies significantly, so never assume you qualify based only on the program's headline. Read the official requirements carefully before spending hours preparing an application. Number 2. Turn your business plan into prize money. Another overlooked source of non-repayable startup capital is a business plan or pitch competition. Universities, accelerators, corporations, chambers of commerce, entrepreneurship organizations, and community groups sometimes organize competitions where entrepreneurs present their business ideas for the chance to win cash awards or other business resources. These competitions are different from traditional grants. Instead of simply demonstrating eligibility, you may have to convince judges that your business solves a meaningful problem, has a realistic market, understands its customers, can generate revenue, and has a credible plan for using the prize money. This is where having a simple but strong business plan becomes extremely valuable. You should be able to explain what problem you solve, who your customer is, how your business makes money, what makes your offer different, how much money you need, and exactly what that money will accomplish. For example, asking for $10,000 because you need money to start is vague. Explaining that the money will purchase essential equipment, cover required licensing, launch a basic website, and fund the first customer acquisition campaign gives judges a much clearer picture of how their money could move the business forward. Even if you do not win, participating can still create value. Preparing your financial numbers forces you to think carefully about startup costs. Presenting your idea improves your pitch. Feedback can reveal weaknesses, and the competition itself may introduce you to mentors, business owners, potential partners, or other funding opportunities. Number 3. Let future customers help fund the beginning. Crowdfunding provides another way to raise startup money without using a traditional business loan. Instead of borrowing from one lender, you present your idea to many people who can contribute relatively small amounts. Depending on the crowdfunding model, supporters may donate money or receive a product, reward, or other benefit. Reward-based crowdfunding can be especially useful when your business has a product people can understand before it officially launches. Instead of manufacturing a large quantity first and hoping customers eventually buy it, you may be able to test demand by presenting the concept and collecting support or pre-orders. Donation-based crowdfunding works differently. People contribute because they want to support the person, mission, community, or project rather than receive ownership in the company. This can work in certain situations, but it should never be treated as guaranteed startup funding simply because a campaign has been published. Successful crowdfunding usually requires trust, a compelling reason to contribute, clear communication, and promotion. Simply creating a campaign page and waiting for strangers to discover it is rarely a complete strategy. You need to explain why the business matters, what the money will accomplish, and why supporters should believe you can execute the plan. The larger lesson is simple. Before automatically borrowing startup money, investigate funding that may not create repayment obligations. Grants, competitions, and crowdfunding will not work for every business, but finding even one suitable opportunity could reduce the amount you need to borrow or invest personally. Number 4. Understand what it actually costs to make your business legal. Before looking for thousands of dollars in funding, calculate how much money you actually need to establish the business legally. Many first-time entrepreneurs imagine that forming a business automatically requires a huge amount of money. In reality, the cost depends heavily on your business structure, state, industry, location, and required licenses. If you decide to form an LLC, the state filing fee can vary significantly across the United States. Some states have relatively low formation fees, while others charge considerably more or impose additional annual reports, franchise taxes, publication requirements, or recurring fees. Never build your startup budget around one national estimate. This is why your first step should be checking the official website of the state agency responsible for business filings. Find the actual formation fee, annual or periodic filing requirements, and any additional state obligations. Then investigate whether your city or county requires a separate business license, permit, registration, or industry-specific approval. You should also understand that an LLC is not automatically necessary for every person testing a small business idea. Different business structures have different legal, tax, administrative, and liability implications. Your goal should not be choosing the cheapest structure blindly. Your goal is understanding the structure that makes sense for your situation. One startup item that should not cost you money is an employer identification number, commonly called an EIN. Eligible businesses can obtain an EIN directly from the IRS without paying an application fee. Be careful with third-party websites that charge money simply to complete something you may be able to do directly for free. An EIN is commonly used for federal tax administration and may be needed for activities such as hiring employees or handling certain business banking and tax matters. However, getting an EIN does not automatically create your LLC, provide a business license, or complete every legal requirement your business may have. Create a simple startup registration budget before spending anything. List state formation costs, local licenses, permits, professional fees if needed, and recurring compliance expenses separately. Once you know the real number, you can search for funding more intelligently instead of trying to raise an arbitrary amount of money. Number 5. Do not buy equipment until you know what you truly need. Equipment can quickly become one of the largest startup expenses. A new entrepreneur may think they need a new laptop, printer, business phone, desk, chair, specialized equipment, and several other tools before accepting the first customer. That shopping list can turn a low-cost business into an expensive project surprisingly fast. Separate your equipment into 3 categories: essential now, useful later, and unnecessary for the moment. Essential equipment directly allows you to deliver your product or service. Useful equipment improves convenience but can wait. Everything else should remain outside your startup budget until the business begins generating enough cash to justify it. For example, imagine a service business requires a reliable computer and phone to communicate with clients and perform the work. Those tools may deserve priority. A premium printer, expensive second monitor, high-end furniture, and multiple new devices may improve the workspace, but they might not create the first dollar of revenue. Before purchasing essential equipment, investigate whether local economic development organizations, nonprofits, industry associations, workforce programs, incubators, or specialized grant programs provide technology or equipment assistance. Some opportunities may help qualifying businesses purchase specific tools, but availability and eligibility can vary dramatically by location and program. Do not search only for something called an equipment grant. Search according to the purpose of the program. Technology assistance, digital access, rural business development, workforce development, manufacturing support, accessibility improvements, energy efficiency programs, and community development initiatives may sometimes include eligible equipment expenses. Read the rules before purchasing anything. A program might require approval before the expense occurs, restrict what equipment qualifies, reimburse expenses rather than paying up front, or require the business owner to contribute part of the cost. Buying equipment first and researching the program later could make the expense ineligible. If no assistance is available, consider used or professionally refurbished equipment. A reliable refurbished computer or quality used office furniture may perform the same basic function at a fraction of the cost of buying everything new. At the startup stage, function usually matters more than having the most impressive office. Equipment financing or leasing can also exist as a backup option when an essential asset is too expensive to purchase with cash. But remember the distinction: financing is not free money. It creates future payment obligations. Use it carefully and only when the equipment has a strong business reason behind it. Number 6, build an office that makes money, not one that looks expensive. Many entrepreneurs accidentally spend money trying to make a new business look established before the business is financially established. They imagine a professional office with matching desks, premium chairs, storage cabinets, decorations, conference furniture, and expensive electronics. The office looks successful, but the business may have very little cash remaining. Instead, build what we could call a minimum viable office. Ask one question about every purchase. Do I need this item to operate safely and serve customers effectively right now? If the answer is no, consider delaying the purchase until revenue begins coming into the business. A simple desk, comfortable chair, reliable computer, internet connection, phone, and necessary business tools may be enough for many home-based or service businesses. Depending on what you already own and what your business actually does, your initial office setup could be much simpler than the office you eventually want. Look at used office furniture, business liquidation sales, local resale options, refurbished equipment, and community resources before buying everything at retail prices. Businesses regularly replace furniture and equipment that still have years of useful life remaining. Buying strategically can preserve hundreds or even thousands of dollars. Also investigate co-working spaces, libraries, incubators, small business development centers, and community entrepreneurship programs. Depending on the location, entrepreneurs may gain access to meeting rooms, internet, training, mentoring, workspaces, or other resources without carrying the full expense of maintaining a private commercial office. If you find a grant that allows money to be used for office equipment or workspace improvements, confirm the permitted expenses before spending the award. Grant money is usually restricted by the terms of the program. Receiving funding does not necessarily mean you can spend it on anything your business wants. The goal during the startup stage is not to create the perfect office. The goal is to create the least expensive environment that allows you to operate professionally, safely, and effectively. Every dollar you avoid spending unnecessarily gives your business more financial breathing room. Number 7. Stop paying for software before you have customers. Software subscriptions look inexpensive individually. $10 here, $20 there, and another monthly subscription somewhere else may not feel dangerous. But combine accounting software, design tools, cloud storage, scheduling, email marketing, project management, video meetings, customer management, and other services, and your monthly overhead can grow quickly. Start by identifying what your business actually needs during its first stage. You may need email, basic document creation, invoicing, file storage, communication, and perhaps one or two industry-specific tools. You probably do not need every premium feature available from the beginning. Look for legitimate free plans before purchasing paid subscriptions. Many software companies offer limited free tiers that are perfectly adequate for very small businesses. The free version may restrict users, storage, automation, or advanced features, but those limitations might not matter when you have only a handful of customers. Free trials can also help you evaluate software before committing to an annual contract, but keep track of expiration dates and automatic renewals. A free trial becomes an unnecessary expense when you forget about it and continue paying for a service the business barely uses. Some technology companies also provide startup programs, promotional credits, nonprofit discounts, educational programs, or partnerships with accelerators and incubators. Eligibility varies, and many offers are temporary, so calculate what the software will cost after the promotional period ends before making it part of your operating system. Be especially careful with annual plans marketed as cheaper per month. The discount may look attractive, but paying for 12 months of software before you know whether the business needs it can lock scarce startup cash into the wrong tool. Flexibility can sometimes be more valuable than the lowest advertised monthly price. Create a software audit every few months. Write down every subscription, its monthly or annual cost, how frequently you use it, and whether it contributes to revenue or essential operations. Cancel duplicate or unused tools. Small recurring savings become meaningful when your business is operating with limited cash. Remember the bigger principle behind equipment, furniture, and software. Reducing the amount of money required to start can be just as powerful as finding more money. If you reduce a $10,000 startup plan to $6,000, you have effectively solved $4,000 of your funding problem without taking on debt. Number 8. Protect the business without letting insurance. Destroy the budget. Insurance can become one of the most stressful startup expenses because it feels different from buying equipment or software. You may spend money every month without immediately receiving anything tangible in return. But one uninsured accident, lawsuit, property loss, or other serious event can create a much larger financial problem. Start by separating personal health insurance from business insurance. They solve completely different problems. Health insurance helps protect you against personal medical expenses, while business insurance can protect the company against certain operational risks. Depending on your business, you may need one or several types of business coverage. For self-employed individuals in the United States, the health insurance marketplace is one place to investigate individual and family health coverage. Depending on household income and other eligibility factors, some people may qualify for premium tax credits or other savings that can reduce the cost of marketplace coverage. Do not automatically assume that becoming self-employed means paying the full advertised cost of health insurance without assistance. Compare available plans carefully. Look beyond the monthly premium and consider deductibles, co-payments, provider networks, prescription coverage, and maximum out-of-pocket costs before deciding which plan fits your situation. Health coverage can feel especially overwhelming when you are leaving a job that previously provided benefits. Instead of treating the entire problem as one enormous expense, calculate it separately. Estimate your monthly health insurance cost and include that amount in your personal financial requirements before deciding how much income the business must eventually provide. Now look at the business side. General liability insurance is common for many small businesses because it can provide protection against certain claims involving bodily injury, property damage, and related risks. However, the coverage your company needs depends heavily on what the business actually does. A consultant working from home may face very different risks from a contractor entering customers' properties. A retailer has different exposures from a software company. A business with employees may have additional insurance obligations. A company using vehicles may need commercial auto coverage. There is no single insurance package that fits every startup. Professional liability coverage may also be relevant for businesses that provide professional services or advice. Businesses storing customer information may consider cyber coverage. Companies owning equipment or inventory may need property-related protection. The correct combination depends on your industry, contracts, assets, employees, location, and risk exposure. Instead of purchasing every policy you hear about, identify the risks that could seriously damage your business. Then compare quotes from reputable insurers or licensed insurance professionals. Ask what is covered, what is excluded, what the deductible is, and whether any client contracts or state rules require specific coverage. Insurance should be treated as protection against risks you cannot comfortably absorb yourself. At the same time, you should avoid paying for unnecessary coverage simply because you are afraid of everything that could theoretically happen. The objective is appropriate protection, not maximum insurance at any cost. And if the numbers feel overwhelming, remember that you do not need to solve your entire financial future today. Break the problem into smaller categories. First, calculate health coverage, then required business coverage, then optional protection. Clear numbers usually feel much more manageable than one undefined fear about how expensive everything might become. Number 9. Search for funding based on the expense, not just the word grant. Many entrepreneurs search for free money to start a business, spend hours scrolling through websites, and become frustrated when they cannot find a program that simply gives them unrestricted cash. A better strategy is to search for assistance connected to the specific expense or objective your business needs to fund. If you need a computer, investigate technology assistance or digital development programs. If you need specialized machinery, investigate industry, manufacturing, rural development, or economic development programs. If you need employee training, search workforce development programs. The funding may be organized around the economic goal rather than your personal need for money. Suppose your startup needs $15,000. Instead of assuming you need one $15,000 grant, divide the amount into categories. Perhaps $4,000 is equipment, $2,000 is technology, $1,000 is registration and licensing, $3,000 is marketing, and the remainder represents working capital and other startup expenses. Once the expenses are separated, you can attack each problem differently. Equipment might qualify for one program. Software costs might be reduced through free plans or startup credits. Office furniture might be purchased, used, Registration costs may simply need to be paid personally because they are relatively small. This approach can dramatically reduce your actual funding gap. Imagine your original startup plan requires $15,000. You receive $3,000 from a local program, save $2,000 by purchasing refurbished equipment, eliminate $1,000 in unnecessary subscriptions and furniture, and raise another $2,000 through crowdfunding. You have not found one magical check that funds the entire company, but you have reduced a $15,000 problem to a $7,000 problem. That remaining amount may be much easier to cover through personal savings, early customer revenue, a smaller financing requirement, or additional funding opportunities. This is an important mindset shift. Free business funding is not always about finding someone willing to pay every startup expense. Sometimes the smartest strategy is combining several smaller resources while aggressively reducing unnecessary startup costs. Number 10. Use official sources before trusting grant lists. Whenever entrepreneurs search for grants online, they enter a market filled with useful information, outdated information, aggressive advertising, and sometimes misleading promises. That makes verification one of the most important parts of your funding strategy. For federal grant opportunities, research official government resources such as grants.gov. For small business guidance and local assistance, explore resources from the U.S. Small Business Administration. Your state economic development agency and local government websites can also help identify programs operating closer to your business. Small business development centers can be particularly useful because they help entrepreneurs with areas such as business planning, financial analysis, market research, and access to capital. Available services vary by location, but speaking with a local advisor may help you identify resources you would never discover through a generic internet search. You can also investigate SCORE, women's business centers, veterans business outreach centers where relevant, chambers of commerce, local economic development organizations, universities, business incubators, and community organizations. Some provide funding directly, while others can point entrepreneurs toward programs, competitions, training, or local resources. When you discover a grant through social media, a blog, a video, or a funding database, do not immediately submit sensitive information. Find the organization operating the program. Visit its official website. Confirm the application deadline, eligibility requirements, award amount, permitted expenses, and application process. Watch carefully for anyone promising guaranteed approval. Legitimate grants are usually competitive or eligibility-based. Nobody can honestly guarantee that your business will receive an award simply because you pay them for access to a secret application or grant list. Also understand the difference between an application fee and someone charging you for unnecessary access to public information. Some legitimate competitions or private programs may have their own rules, but government information that is publicly available should not suddenly become exclusive free money simply because someone placed it behind an expensive course. Create a simple funding tracker. Record the program name, official website, amount available, eligibility requirements, deadline, permitted expenses, documents required, application status, and expected decision date. This prevents you from repeatedly searching for the same information and helps you focus on opportunities that actually fit your business. Number 11. Make your business easier to fund before you apply. Finding a grant is only half the job. You also need to make your application credible. Funding organizations often want to understand what your business does, why the money is needed, how it will be used, and what result the funding is expected to create. Start with a clear description of the business. Avoid complicated language. Explain the problem you solve, the customer you serve, what you sell, how you expect to generate revenue, and why customers would choose your business instead of existing alternatives. Next, create a realistic startup budget. Do not simply write equipment $5,000. Identify the major equipment required and estimate realistic costs. Do the same for registration, software, insurance, marketing, inventory, professional services, and other important startup expenses. Then explain how the funding changes the situation. If a $5,000 grant allows you to purchase equipment required to begin serving customers, say that clearly. If funding helps you hire or train workers, explain the expected outcome. Connect the money to something measurable whenever possible. Basic financial projections can also strengthen your preparation. Estimate expected revenue, major operating expenses, monthly cash requirements, and how long your available startup money can support the business. Your numbers do not need to predict the future perfectly, but they should demonstrate that you have thought seriously about the economics. Keep important documents organized before application deadlines arrive. Depending on the program, you may need business registration documents, tax information, financial statements, identification, a business plan, project budget, vendor estimates, certifications, or other supporting material. Most importantly, customize your application to the opportunity. Sending the same generic business description to 20 unrelated grant programs may save time, but it can weaken your chances. Understand what each program is trying to accomplish and clearly explain why your business fits that objective. Think of the application from the funder's perspective. They are not simply asking, "Does this entrepreneur need money?" They may be asking, "Will providing this money accomplish the purpose of our program?" Your application becomes stronger when it answers that second question clearly. Number 12. Do not wait for grants before you start making progress. One of the biggest mistakes is building a startup plan that works only if you receive a grant. You may find an excellent opportunity, meet the eligibility requirements, submit a strong application, and still receive nothing. Some programs are highly competitive, have limited funding, or take months to announce awards. Build two versions of your startup plan. The first can show what you would do if you receive outside funding. The second should show the smallest realistic version of the business you could launch without that funding. This prevents one rejected application from stopping the entire business. Ask yourself what you actually need to reach your first paying customer. You may discover that the full business requires $20,000, but the first revenue-producing version requires only a few thousand. Once customers begin paying, some future expenses can potentially be funded from business revenue instead of personal savings. This is where starting lean becomes extremely powerful. Instead of buying 5 pieces of equipment immediately, perhaps you start with the 2 that are essential. Instead of renting a private office, perhaps you initially work from home or use a flexible workspace if your business and local rules allow it. Instead of purchasing expensive software for every possible future need, begin with the tools required for current customers. Instead of spending thousands of dollars building a perfect brand, focus first on a professional basic presence and a reliable way for customers to discover, contact, and pay your business. You can also look for ways to generate revenue before making every planned investment. A service business might begin with a narrow service offering. A product business might test demand through pre-orders or a small initial production run. The objective is to validate demand before committing large amounts of money. However, starting lean does not mean ignoring legal requirements, safety, licensing, insurance, or professional standards. Saving money by delaying a decorative office upgrade is very different from avoiding a legally required permit or operating without necessary protection. Think of grants as an accelerator rather than the foundation holding your entire business together. If funding arrives, it can help you purchase equipment faster, improve technology, expand marketing, or build capacity. If it does not arrive, you should still have another path forward whenever realistically possible. Number 13. Build a funding stack instead of searching for one perfect check. Many people imagine startup funding as one transaction. They believe they need $10,000, so they search for one organization willing to give them exactly $10,000. In reality, your startup may become much easier to fund when you combine several smaller resources. Imagine you calculate that your business requires $12,000 to launch. After reviewing every expense, you eliminate $2,000 by delaying non-essential purchases. Now the real requirement is $10,000. That reduction is effectively your first funding victory because you no longer need to find that money. Next, perhaps you qualify for a small local program that provides $2,000 toward approved equipment. Your remaining funding gap falls to $8,000. Then you purchase some refurbished equipment instead of buying everything new, saving another $1,000. You find legitimate startup software credits and free plans that eliminate several $100s of initial technology expenses. You already own a desk and usable phone, so those items disappear from the startup budget. Suddenly, a business that originally appeared to require $12,000 may require much less cash. Perhaps you then enter a business competition. Winning would be helpful, but your plan does not depend on it. You may also launch a crowdfunding campaign if your business is appropriate for that model, or use customer pre-orders where they make commercial and legal sense. Only after exhausting suitable non-repayable resources and cost reductions should you evaluate whether a remaining funding gap needs savings, financing, or another source of capital. If borrowing becomes necessary, reducing the gap first means you may need substantially less debt. This approach is your funding stack. It might combine grants, competition awards, crowdfunding, startup credits, existing resources, used equipment, early customer revenue, and personal capital. Not every component is literally free money, but together they minimize how much expensive capital the business requires. The strongest startup funding strategy is often not finding the biggest possible check. It is intelligently solving each expense using the cheapest appropriate source available while protecting the business from unnecessary financial pressure. Number 14, understand what free money really means. There is something extremely important to understand about the phrase free money. A grant may not require repayment, like a loan, but that does not necessarily mean there are no conditions attached to the funding. A grant may restrict how the money can be spent. Equipment could be allowed while owner compensation is prohibited. Marketing might qualify while rent does not. Another program might support employee training but not inventory. The rules depend entirely on the specific award. Some programs may also require progress reports, receipts, documentation, proof of eligible expenses, project updates, or other records. If you receive funding for a particular purpose, maintain clean records showing exactly where that money went. Taxes are another reason to keep good records. The tax treatment of grants, crowdfunding proceeds, prizes, and other funding can depend on the facts and circumstances. Do not automatically assume that money you do not repay is also money you do not have to report for tax purposes. A qualified tax professional can help you understand how a particular funding source applies to your business. This becomes especially important when the amount is significant or when the funding arrangement includes unusual conditions. Crowdfunding also requires careful planning. Depending on the campaign structure, money may represent donations, business income, advanced sales, or another type of transaction. If supporters receive products or rewards, remember that fulfilling those promises creates real costs. The process may feel overwhelming when everything is mixed together. Once you separate it into small decisions, it becomes much easier to manage. You do not need every dollar today. You need a clear plan for finding, saving, earning, or responsibly financing each dollar when the business actually needs it. And remember, the objective is not simply to get free money. The objective is to build a financially healthy business that can eventually generate enough cash to support itself, pay you, invest in growth, and create opportunities without constantly depending on outside funding. If you found this video helpful, then like, share, and subscribe this channel to get future videos. Thank you for watching this video.